Hello everyone, welcome to another video for CFA Level 1. In today's video, we will have a complete and in-depth discussion about capital structure theories. So what is capital structure theories? See, if you look at from a layman terms, capital structure theories are nothing but different school of thought with respect to how a company should have a capital, what kind of capital structure a company should have. Okay. In the previous video, we have already seen what is a capital structure. Capital structure is nothing. It is majorly mix of debt and equity. So basically over the years, different scholars have done research and they have prepared their school of thoughts that how much debt for a company is good, how much equity for a company is good, what should be the mix and the ratio between debt and equity, and how this capital structure affects the valuation of the company. Okay, so they have given their own theories, they have given their own school of thoughts, which we are studying now. Now guys, you need to understand that these theories do not completely apply on the real world in totality, because whenever these theories are made, there are some constant, there are some limitations, there are some assumptions on which these theories are said or these theories are developed. Okay, so we will be seeing some of these theories. So when you hear them, don't think that this is being impractical or this is being very bookish. You need to understand there are certain set of assumptions, there are certain set of limitations when these theories were written, when these theories were thought of, and that is how the output has come out, right? With the new world, with the world changing, a lot of variables have changed, right? So this might not be applicable in real life, but yes, this will give you a foundation to understand a company's debt and equity mix in a better manner. Okay, so let us start. Initially, we are given the definition of weighted average cost of capital. We already know what a weighted average cost of capital is. What is a WACC? It represents the blended cost of capital from all sources of fund like common shares, preference shares, debt. Right? We all know what is a WACC. We have seen it in the previous two classes. We have understood it very nicely. And now let us come to the capital structure theory. See, if you look at the summary, in capital structure theory, there are only two broad theories. Okay, one is known as the traditional theory, and the other is known as Modigliani-Miller theory. Okay, so basically there are two capital structure theories. One is the traditional theory and the other is a Modigliani-Miller theory. However, when we talk about the Modigliani-Miller theory, different conclusions have been provided given there are different constant, given there are different assumptions in a company, right? So they were divided into MM1 proposition. MM stands for Modigliani-Miller, MM1 proposition and MM2 proposition. Okay, and further this MM1 and MM2, again depending upon the different variables and the different different assumptions, they were divided into MM2 with tax and MM2 without tax. Okay, so basically in all, in Modigliani we have primarily three theories to study and one theory we have from the traditional lens. So ideally capital structure theory can be broken down into two, traditional and Modigliani. Modigliani further into two, MM1, MM2, and MM2 can be divided into two, MM2 without taxes, MM2 with taxes. Are we clear, guys? Are we clear on how the entire capital structure setup looks like from a theory lens? Okay. Now let us take it up one by one. Guys, trust me, it is a very simple theory, very logical. You will understand everything is based on assumption. Okay. MM proposition 1, no taxes. So you need to understand when this we were talking about Modigliani-Miller, MM1 already had no taxes. So basically, what does it mean, no tax? It assumes the economy is tax free. Economy is tax free. So this is an assumption that Modigliani-Miller model is making, that your economy is tax free. On the other hand, when you are talking about MM2 model, it is broken into two, with tax or and without tax. So without tax also assumes that economy is tax free, whereas with tax assume that economy has taxes. Okay guys, are we clear? Okay. Now let us see what this theory says. Under this theory, with certain set of assumptions. See guys, this phrase is very important. Under this theory with certain set of assumptions. So it is clearly stating that whatever is told in this theory is based on certain set of assumptions. Okay. The value of a firm is unaffected by the capital structure. This is also a very important phrase. So, as per MM1, the capital structure of a firm is not impacting its value. Okay, so basically, irrespective of the amount you take debt or irrespective of the amount you put in the equity, the value of the company afterwards remain the same. Okay, the set of assumptions. Now it is important. It can also come as a question that they can give you an assumption and then they can ask which capital structure theory it belongs to. So you must, not memorize it, but understand that these set of assumptions belong to which set of capital structure proposition. Okay, what is it? First assumption is capital markets are perfectly competitive. What does it mean? It means there are no transaction costs, there are no taxes, there are no bankruptcy costs. So guys, can you tell me? Is it really true? Can we say capital markets are competitive because they don't have costs? No, you have taxes, you have transaction costs. So in real life, this assumption doesn't hold true, right? But for this model, in order to make the statement that irrespective of debt and equity in the company, the value of the company is same, we are making this assumption. Okay. The second, proposition: investors have homogeneous expectations. Okay, they have the same expectation with respect to cash flows generated by the firm. So basically, what it is saying that investors have homogeneous expectation. What does it mean? It means that whether I am an investor or whether you are an investor, what we expect from the cash flows of the company is same. Basically, my expectation is same as yours. Again, is it true? No, because I might expect something else from the company. You might expect something else from the company in terms of cash flow, right? So again, another assumption. The third assumption and the very important one, 3 stars. There is a riskless borrowing and lending, which means investors can borrow and lend at risk-free rate. Very important. This assumption totally ignores the concept of float. It ignores the concept of spread. Okay, what it is saying that borrowing and lending both occurs at RF. Is it true? Do we say that borrowing and lending always occurs at an RF? We all know there is a risk premium attached to any lending or borrowing activity. There is a risk premium attached to every lending and borrowing activity. Not only risk premium, there is a liquidity premium attached to every borrowing and lending activity. Correct. There is a convenience premium attached. So This riskless borrowing and lending is again a very important assumption that this model is making. The fourth, there is no agency cost. Guys, I hope you remember it from our discussion. What is agency cost? Agency cost is the conflict between the shareholders and the managers of the company. Conflict between managers and the shareholders of the company. Guys, we have seen this. If you don't remember it, please browse through my earlier CFA videos. There is the discussion and complete understanding about agency cost in the ethics portion. Okay. The fifth assumption is investment decisions are unaffected by financing decisions. Operating income is independent of how a firm is financed. So what it is saying that the decision that you make about investment is unaffected by financing decision. So guys, if you would have seen my video on working capital and liquidity, can you say whether this statement is true or not in a real life parallel sense? No, because depending upon where a company wants to invest, depending upon where a company is willing to invest, it decides to raise funds. Correct. So definitely investment actions are dependent on the financing actions and vice versa. Okay. So MM1 says that the capital structure does not affect the value of a firm. However, there are 5 assumptions. Now we come to Modigliani proposition 2 with no taxes. So that was 1. This is 2. Okay. What it is saying, theory proposes that investors are rational and thus KE is directly proportional to the level of gearing. What is KE, guys? We have seen KE is nothing but cost of equity. Guys, KE is nothing but cost of equity. K is nothing but cost of equity. It hints for the linear relationship between KE and gearing. So what it is saying is that, see, you have 3 rates in a company: cost of capital, which you can say as WACC or can be written as KO. You have cost of debt, which we have seen as KD, and we have cost of equity, which is nothing but KE. Okay. Modigliani-Miller 2 proposition without taxes says that if you increase your debt, okay, then this situation is called as you are increasing the gearing. Correct. Gearing is basically known as taking debt. Okay. When you increase the debt, we can say that you are increasing the gearing. Gearing is nothing but taking debt. Okay. Gearing is nothing but taking debt. When we are taking more debt, can we say our debt to equity ratio will increase? Can we say our debt to equity ratio will increase? Yes, 100%. So what will happen when our debt to equity ratio will increase is that there will be a simultaneous increase in the KE. So basically what it is saying is that when your debt to equity ratio is increasing, your company becomes financially risky because the fixed obligation goes up. Because the risk is going up, the cost of equity, which is owner's capital, is also increasing. We know cost of capital is based one of the factors which dictate cost of capital is risk. So when the company is taking more and more of debt, the company becomes financially risky. when the company's risk profile is increasing, what do we say? When the company's financial risk profile is increasing, the risk of the company is increasing, and because of that risk, KE will also increase. And Modigliani-Miller 2 model is saying that this increase is linear in nature. So basically, when you increase the debt by 5%, then KE will also increase by 5%. Okay. Now what will happen? Since KO is nothing but weighted average, weight into debt, weight into KD plus weight into KE, as soon as you increase this weight, okay, as soon as you increase this weight, the weight for KE will come down, okay, but the rate for KE will go up. What this will ensure is that KO is same irrespective of your debt and equity mix. This is the final important statement which Modigliani-Miller 2 model without taxes are saying. It is saying that the cost of capital of the company will remain the same irrespective of the amount of debt you take. And why it will remain the same is that as you increase the amount of debt, KE will linearly increase. Okay. See this diagram. This is cost of capital. This is my, leave the gearing part if you don't understand. Just understand debt to equity ratio. Okay. What is happening? When you go to the right side of the x-axis, your debt to equity ratio is increasing. Since my debt to equity ratio is increasing, you will see a linear increase in my KE. Okay. And since my KE is increasing, okay, my KD is lower. The weight of KD is increasing, whereas the weight of KD is increasing, weight of KE is decreasing, but KE itself is increasing. So their average will be constant. So if you look at this line, the average is constant. The WACC of the company is not changing at all. The WACC of the company is not changing at all. Are we clear, guys? Then we come to the next proposition. The proposition is similar to the previous proposition, just the only difference is this is with taxes. What does it say? It provides that the interest on debt additionally provides for tax benefit, and thus taking debt over equity provides a beneficial option regardless of current capital structure. So what it is saying? See, in the Modigliani-Miller 2 model with taxes, it is saying that the interest paid on debt is tax deductible. Yes or no? So the actual cost of debt is not, so the actual cost of debt is actually not KD. It is KD into 1 minus tax. Why? Why KD into 1 minus tax? Suppose I have borrowed 100 rupees. Okay, suppose I have borrowed $100 at a rate of 10%. So my interest cost is 10. Over here from this logic, my KD is 10. Correct? Now suppose I draw up a financials, and in the financials my revenue is 100, okay, and I have no other expense. So in absence of debt, if tax rate is 25%, my tax will be $25, and the net I will take home is 75. Okay. However, if I have a debt in place, so my revenue is 100, my interest is 10, so I am left with 90, tax is 25, so I am left with 22.5, and my net take home is 70. Sorry, 68.5, 67.5. Guys, my net take home is 67.5. So you see, with debt being in place, okay, my profit fell from 75 to 67.5, which is just 7.5 and not 10. Ideally, when it was debt in place, profit before tax fell from 100 to 90, correct? But profit before tax fell from 100 to 90, but profit after tax fell from 75 to 67.5, which is just 7.5. So can we say 7.5 is the actual cost of debt? Now how the 7.5 came in? 7.5 is nothing but, sorry, 7.5 is nothing but 10, which is the KD, into 1 minus tax. What is 1 minus tax? 1 minus tax is 1 minus 25%, or 1 minus 0.25, 10, which is 10 into 0.75, which is 7.5. Are we clear? So Modigliani-Miller 2 proposition says that I assume that tax exists in an environment. Because of the existence of tax, the cost of debt is not KD, the cost of debt is KD into 1 minus tax. And if you see, in the earlier class, I had asked you to ignore one thing. Just see, I had asked you to ignore this thing. And I told you that we will discuss it in some class in future. This is the discussion. So everywhere, whenever you are considering cost of debt is not considered as KD, it is considered as KD into 1 minus tax. Why? Because it provides us with tax benefit, unlike equity, retained earnings, or preference shares as a source of capital. Okay. So what it is saying that since KD is not KD, it is even lower, it is KD into 1 minus tax. When we increase the debt to equity ratio, the KE increases. Okay, that is agreed. Till that point, both are same. Till that point, KE is increasing. I am agreeing to it. But the increase in KE is less than the benefit from taxation, and thus your overall WACC comes down. Guys, are we clear? Are we clear of the entire thought process? So in Modigliani-Miller 2 model without taxes, we were saying that WACC remains constant. In the Modigliani-Miller model with taxes, we are saying that no, when you increase the amount of debt, your WACC comes down. Okay. Now we come to the last theory, which is known as the traditional theory, or also known as the static trade-off theory. So it is traditional theory or static trade-off theory. What is static trade-off theory? So basically what this model is saying, and this is the most realistic model. Okay, what it is saying, initially it is basic thing. It is based on logic and not theoretical as a explanation. So basically you will be able to relate with it. What it is saying is that as the entity increases its debt, the WACC will come on falling. Okay, so when the company is increasing the debt, the WACC will come on falling. Till this portion, this is same. This is same as MM2 with taxes. Now here comes the twist. However, after a certain point, the increase in the cost of equity will outweigh the cheaper debt financing, and thus the overall cost of capital will increase. This is the twist. Twist in traditional theory. So what it is saying that initially when you increase your debt, your overall cost of capital will decrease. Why? Because you are taking benefit of the cheaper debt. But after a point of time, when your risk of the company increases, then your cost of equity becomes so expensive that your overall cost of capital will increase. So basically what it is saying, it is cost of capital, it is debt to equity ratio. Okay, you are going from lower to higher debt to equity ratio. It is into three stages. In the first stage, when the debt is increased, what will happen? Your, suppose this is a KD. Okay, your KD is over here. Your KE is this. Your WACC will come falling. Okay, this is stage one. Stage one. Okay, now what will happen? You increase the KD, you increase the debt. The increase in KE becomes very high. So what will happen? Your WACC will start to increase. Okay, this is stage two. Okay, in the third stage, it becomes very interesting. In the third stage, your KD itself will also increase. Why? Because the company is now very risky. So anyone putting his money, even as debt, needs a higher risk premium. So your WACC is increasing, your KE was anyway increasing. So stage one, when you increase the debt, WACC falls down, although KE is increasing. Stage two, you increase further debt, WACC starts to increase. Why? Because the KE becomes very high. In the third stage, since the risk in the company has increased to such a level that your KD itself is rising. Okay. See, here is the graph if you want for reference. Cost of capital, gearing. Initially, in the stage one, your debt is increased, KD is constant, WACC is coming down. In the initial stage, your KD is constant, WACC is coming down, KE is increasing. This is stage one. In stage two, KD is constant, but WACC is increasing. Why? Because KE is increasing at a higher stage. In stage three, your KD itself is increasing, WACC is also increasing, KE is also increasing. Guys, are we clear? Guys, are we clear? Okay. Now there is one additional formula, guys, which I want you guys understand. On the static theory, which is the value of the firm. So it is saying that value of a leveraged firm is nothing but the value of an unleveraged firm plus the tax benefit on debt minus present value of financing distress, cost of financing distress. This is a formula hardly used, but logically we will read it in separate chapter. But I want you to understand that what it is saying is that value of a leveraged firm. So basically value of a firm which has debt is equal to value of a firm which is debt free plus the benefit of debt. What is the benefit of debt? It is the tax benefit, so tax into debt minus the cost of debt. Cost of debt. What is the cost of debt? When you borrow, you have a lot of financial distress, so it is nothing but present value of financial distress. So basically what it is saying, for a firm which has debt in it, its value is equals to value of a debt free firm plus the benefit of debt minus the cost of debt. What is the benefit? The benefit is the tax benefit, so tax into debt. And what is the cost? The cost is the distress or the discomfort or the difficulty or the nuance it comes for when it comes to raising the fund in debt. So it is given in that manner. Okay. So guys, I hope you have understood and appreciated this topic. This is a very important topic. It is not only useful for CFA but also for other professional courses. If you are pursuing your graduation degree in finance, it is also used over there. So I hope this video is useful to you guys. And in the next video, we'll come out with really interesting topic again belonging to CFA Level 1. Thank you guys.